Protective puts, covered calls, and principal protected notes are among the most widely used option-based investment strategies for managing portfolio risk and generating returns. A protective put strategy involves purchasing a put option while holding the underlying asset. This combination limits downside risk because the put option increases in value if the asset price declines. Investors use protective puts as a form of portfolio insurance during periods of uncertainty or expected market volatility. Although the strategy reduces downside exposure, the investor must pay the option premium, which reduces overall returns if the asset price rises. The program highlights protective puts as important hedging tools in risk management and portfolio protection. Covered call strategies involve holding a long position in an underlying asset while simultaneously writing call options on that asset. The investor receives option premium income, which provides partial downside protection and enhances portfolio income. However, the strategy limits upside potential because gains above the option strike price are surrendered if the option is exercised. Covered calls are commonly used when investors expect moderate price appreciation or stable market conditions. Since the investor already owns the underlying asset, the risk is lower than that of uncovered call writing. This strategy is particularly attractive for income-oriented investors seeking to improve returns while maintaining ownership of the underlying securities. Principal protected notes, PPNs, are structured financial products designed to provide investors with exposure to market upside while protecting some or all of the initial principal investment. These instruments typically combine a zero-coupon bond with options or other derivatives linked to equities, commodities, or indices. The bond component grows over time to return the original investment at maturity, while the derivative component provides participation in favorable market movements. PPNs are attractive to conservative investors who seek growth opportunities without fully exposing capital to market risk. However, returns may be capped, liquidity may be limited, and credit risk associated with the issuer remains an important consideration for investors. Option spread strategies involve combining multiple option positions to create specific risk-return profiles. Spreads are designed to limit risk, reduce option premiums, or profit from particular market expectations. Bull spreads are used when investors expect moderate price increases, while bear spreads are appropriate when moderate price declines are anticipated. These strategies may involve combinations of calls or puts with different strike prices or expiration dates. Because both long and short option positions are included, spread strategies generally reduce both potential profits and losses compared to outright option positions. Option spreads are widely used because they provide flexible methods for controlling risk exposure and managing trading costs. Calendar spreads and diagonal spreads are more advanced option spread strategies that involve differing expiration dates and strike prices. Calendar spreads typically involve buying and selling options with the same strike price but different maturities, allowing traders to profit from differences in time decay. Diagonal spreads combine different strike prices and expiration dates, creating more customized payoff structures. These strategies are particularly sensitive to volatility and time decay assumptions. Traders use them to express views on future market volatility, price direction, or the timing of expected price movements. Effective management of these strategies requires careful monitoring of changing option sensitivities and market conditions. Option combination strategies involve simultaneously using multiple options of different types to create complex payoff patterns. Common combination strategies include straddles, strangles, butterflies, and collars. A straddle involves purchasing both a call and a put with the same strike price and expiration date, allowing the investor to profit from significant price movements in either direction. Strangles are similar but use different strike prices, reducing initial cost while requiring larger price movements for profitability. Butterfly spreads combine multiple options to profit from low volatility and stable prices. These strategies allow investors to tailor risk exposures based on expectations regarding volatility, price direction, and market uncertainty. Collar strategies combine protective puts and covered calls to create a range-bound return structure. In a collar, an investor purchases a protective put to limit downside risk while financing part or all of the put premium by writing a covered call. This approach reduces hedging costs but also caps potential upside gains. Collars are commonly used by institutional investors and portfolio managers seeking to preserve capital during uncertain market environments. Because collars define both maximum losses and maximum gains, they provide predictable risk-return outcomes. The program emphasizes collars as practical examples of combining derivative instruments to manage portfolio exposures efficiently while balancing risk reduction and return objectives. The program highlights option strategies as essential tools for financial risk management, portfolio construction, and investment optimization. Protective puts, covered calls, spreads, and combinations allow investors to tailor exposures according to specific market expectations and risk tolerances. These strategies demonstrate how options can create nonlinear payoff structures that differ substantially from direct investments in underlying assets. Financial institutions, hedge funds, and portfolio managers use option strategies extensively to hedge market risk, generate income, manage volatility exposures, and enhance portfolio efficiency. Understanding the mechanics, risks, and payoff characteristics of these strategies is therefore critical for financial risk professionals involved in derivatives trading, asset management, and structured product analysis.